Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Connie Hill, 20-plus year veteran of the financial markets. She's there to help answer your questions. Thanks for being here, whether you are in the live version today or in the recorded version. It doesn't matter. We're glad to have you here with us. Be a part of the conversation. Leave us a comment in the comment section if you're in the recorded version. If you're here in the live section, ask Connie a question, be a part of that conversation. So we're going to compare and contrast our traditional, the one that we've been doing for a while, that makes it a tradition, I suppose, 14 days till expiration, 7 days to go until expiration strategy versus the one that we started last week, which was a little bit further out in distance, and not in time, but in distance from the current trading price of an index, and a little bit narrower and a little bit faster conversion between selling call spreads versus selling put spreads. You'll see what I mean when we get into the discussion here in just a minute. But a couple of quick housekeeping items as we get started today. Remember that everything we talk about simply for illustrative and educational purposes only. It is not any kind of a recommendation. Remember that past performance, no guarantee of future results. When we start talking about options, remember trading equity and index options carries a high level of risk. They are leveraged products. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, the strategies that we will talk about, the options that we're going to talk about in this webcast, these will all be European style index options, which means that they cannot be exercised until expiration, which means that there is no early assignment risk. But if you are trading a product, like most equity options, those are American style. Those can be exercised at any time, which means that anytime you are short those options, there is early assignment risk. Just be aware of that. Now, when we talk about trading shorter term timeframes, because we get closer to that 0 DTE threshold, recognize that there are some risks that crop up, including gamma risk, including liquidity issues, and there is the potential that price could move very, very quickly one way or the other, and put a trade that was a winning trade into a losing position and vice versa. So that being said, just be aware of those potential risks. There's the possibility that you try to initiate a trade in that 0 DTE or close to expiration time frame, that the order may get rejected, in fact, for some of those reasons. Remember that we're going to use some technical analysis here. It is theoretical in nature. It is not a guarantee future success out there in the real world. Also, we're going to use the thinkorswim desktop software platform, specifically the paperMoney version. It is also not a guarantee of real world success, but it is a great learning environment. Be aware of the fact that there are some characteristics of the paperMoney platform that are different when you move to live trading, including fill prices. So be aware of that. Also, remember that stops aren't a guarantee. Whether you're using a buy stop or a sell stop, it doesn't matter. There's no guarantee that the execution of a stop order will be at or near the stop price. In the event of stop limit order, there's no guarantee that that order will get executed at all. So just be aware to keep those things in mind. Let's do this. Let's pop over to the thinkorswim desktop software platform, kind of see where the market is at the moment, and then we'll jump into a couple of strategy ideas and kind of do that compare and contrast. So for those of you that have been with us for a while, you are familiar with the 14-7 strategy. For those of you that are brand new, this may be brand new to you. We're going to talk through it as we get into the discussion, but it all begins with an understanding of what kind of the market posture is and what's going on with the market. So I have the S&P 500 here on my grid chart, my index grid, and we can kind of see that the S&P, from where we were last week, pulled back and then has started to rally back up. It is not currently above the 50-period moving average. It's kind of sitting and touching that 50-period moving average in the S&P 500. So here we have 1 back in November, 2 in December, 3 in January, 4 in February, 5 in February, 5 times in the last 3 months or 4 months that we've dropped below the 50 period, and in fact ended up closing below the 50 period simple moving average on the SPX. We're now trying to, or it's now struggling, it seems, at this point to make that move back up above the 50 period. 200 period still intact, still moving higher. But the RSI, you can kind of see, is rolling over a little bit. There is, as Zinc says, a little bit of end-of-day weakness here, perhaps. We're kind of getting, if you wanted to look at this in terms of candlesticks, you saw almost a hammer-like candle, and you see almost an inverted hammer-like candle today. So sometimes that's referred to as diverging lines bearish, because you're getting a bearish push to the downside, a bullish return back into the upside, but it's getting rejected. And in this particular case, getting rejected up here at this resistance level right about the 50 period moving average. So the SPX showing a little bit of strength, but also a little bit of weakness today. Shorter term RSI turning back up a little bit, but overall RSI rolling a little bit lower. Looking at the NASDAQ, same kind of thing, although what we've done is we've created a lower low below that 50 period moving average, looking a little bit weaker even than the S&P 500. And we got to see this move back up above that resistance level. And I would answer Thaya's question by saying this. It's probably not going to be the ones that are in leadership at the moment in terms of performance. Perhaps not energy, perhaps not consumer staples. We got to see those technology sectors, because remember what the composition of the S&P 500 is, what the composition of the NASDAQ is. Composition of those indexes is largely skewed to technology, and so technology is not performing well. It's not going to drive these indexes higher. So that's something to pay attention to. The Russell 2000, the kind of broader small cap sector, or small cap index, in this particular case, starting perhaps to build this kind of skewed double bottom here off of the 50 period moving average, bouncing a little bit higher, a little bit of a price discovery test higher, but RSI making higher lows at the same time price is making higher lows, so it's echoing. So maybe we're seeing a little bit of rotation to the small caps, but remember the small caps over the last 2 years, because remember the small cap index, the Russell 2000, rebalances every June, and the last 2 rebalances have skewed the percentage of the components in the Russell 2000 more heavily towards technology as well. But more broadly diversified technology, not just, say, for instance, 7 leaders, for instance. So some leadership coming out of the Russell 2000 here and moving a little bit higher, still kind of staying within a relatively neutral range here at this particular point. Now, let's do this. I want to pop over here really quickly while we're talking about this. I want to pop over to our VIX grid. We had this discussion last week. We're going to have this discussion today. We're going to have this discussion kind of on an ongoing basis, because volatility is calling the tune here to a certain extent. We see volatility a little bit elevated. It's in the high 19s. In this particular case, it was higher yesterday and fell off a little bit. I talked about this, and we, in fact, I think traded this in the futures webcast yesterday morning. Remember, if you're going to trade futures, those are highly leveraged products. They're not suitable for all investors. They require separate trading authorization. Make sure you understand the characteristics of those trades before you consider trading any futures products. But you can kind of see what's going on here in the VIX, in that we got a little bit of a push lower. It's come back in here towards the end of the day. This VIX was lower. VIX is rising. Now, in a trade, in an index trade, especially one on, say, for instance, the SPX, there is going to be a strong correlation to implied volatility for those individual options and what's going on with the VIX. Because remember, this is an average of in the money, at the money, and out of the money index options on the S&P 500 over a course of a 30-day average. So this is going to be reflective of those prices. So when the VIX is rising overall, and it is elevated, if we go back to where we were a week ago, the VIX was in the 17s, and it's now in the 19s, 20. So that's 2% higher. 2%, depending on your Vega number, could be the difference between profit or loss in some of these trades. So that's important. An important consideration is, what is the VIX doing? And that may also be one of the reasons why, as we look at some of these trades, we're still at a point where volatility, or where Vega sensitivity, hasn't completely dropped off the board. Vega, the option Greek Vega, is the only one that doesn't get bigger or remain constant as we get close to expiration. Vega influences, in fact, get smaller the closer we get to expiration. So they become less of a consideration. So if implied volatility is a concern, that may be shifting time frame selection to a shorter time frame. But there are always other balances and other considerations. So here's where we are with volatility. Markets moved down a little bit, but rallied back up. Volatility has moved up, but fallen back a little bit lower. It starts to increase a little bit. And just as we've been talking, that volatility has gone up just about 0.1%. So let's pop over really quickly here to our monitor tab and take a look at some of the trades that we put on last week. So the traditional, if you will, strategy that we've been working on in this particular class as a means to establish consistency primarily is a strategy that I call the 14-7 strategy. We sell at 14 days to go until expiration a short vertical spread on the SPX. We buy it back at 7 days to go until expiration, come what may. Now, that was the traditional standard. We do it at one standard deviation, which ends up typically being about the 16-cent or 17-cent delta. So a high probability of success trade. The return on risk is a little bit skewed, but that's because it's a high probability trade. So here's the one that we sold last week. We sold the 67.20, bought the 6,700, so 20 points wide. We sold it for $2.20. It's currently trading at $3.10. So let's go back to that chart really quick. What I'm going to do is I'm going to go to the charts tab here. I'm going to change this to our grid that we've built specifically for this. This is our index options grid. For those of you that are brand new to this discussion, this is a grid that is linked in the description. So I'm gonna summarize, Harry, generally, because I can't share exact numbers, but generally, because of the high probability nature of this trade, we have taken significantly more winning trades than we have taken losing trades. The number of max theoretical losses that we've taken has been less than 10 in the year that we've been doing this, and more than a year that we've been doing this. The number of some loss trades that we've taken is more than 10, but it is not a significant number relative to the number of winning trades that we've had. So more winning trades than losers. When we lose, we lose theoretically less than max loss. Sometimes we will take a maximum loss trade. And it's simply because we are filtering for trend direction and we're putting on a highly probable trade. Again, your mileage will vary. This is not a guarantee. This is not a recommendation or an endorsement of a particular strategy. This is simply an example of a way that a trader could use an index option strategy to generate income on an ongoing basis consistently. Now, you're going to take losses. Not every strategy, in fact, no strategy that I know of, is free from the potential of loss, other than, to quote Joshua in War Games, the best strategy is not to play. So, and we know that that's not necessarily the case with trading. Maybe nuclear war, not necessarily with trading. All right, so here's what we've done. Let's go back and look at this side of the chart. The right-hand side of the chart is our 3-month 1 day. So it's kind of zoomed in so that we can see this a little bit better. And here's the one that we sold most recently, the 67.20. So when we sold it, let's go back to 211. Let's go back here. Here's 211. Here's where the market was. The market was higher on 211 when we sold this. It's gone down and it's started to rally back up. Yeah, so let's take a look at that. We'll do that, Jerry, here in just a second. We'll take a look at that particular strategy. So the market has gone down. It's rallied back up. It kind of moved back higher. But nevertheless, if we go back again to 211, you can see where implied volatility was right down here at about the 17 handle. Implied volatility right now sitting just under 20. So we've had 2% increase in implied volatility, and we've had a drop in the market. That's both of those factors have worked against us in this particular case. Not the ideal situation. I mean, we haven't had an abject blowout to the downside. We've kind of had that confluence of a couple of things that have been working against us. The one thing that has been working for us here is, and always will be, when we're short an option, always will be time decay. So that's the question. So the other thing that we have done in putting this strategy together is, starting last week, we kind of experimented with, we riffed on this a little bit. So let's walk through this one first, and then let's kind of come back and look at those riffs. So what I'm going to do is I'm going to go to the Analyze tab, and I'm going to go to the Risk Profile, and we're going to bring this up, and we're going to say, all right, let's put this on and see what we've got. So I know we are short the 6720, so we're going to keep that one, and we're along the 6700. So we're going to take these ones off, and we'll take that one off. Okay, so here is our short put vertical spread looking at the Analyze tab, right? And I'm just looking at positions here. These are positions that I've already put on. We can take these out because those aren't traded. We'll just take those out of the mix. So it's just this short put vertical spread expiring on the 25th, which is 7 days from now. So you can see where the market, again, going back to where that expiration is, I'm going to take this out to the 25th, because remember, these expire on Wednesdays, because we're looking at options that have, because these are indexes, we have an expiration every day on this particular index. Not on every index do we have that. But here's what we've got. You can see that range. This is the 1 standard deviation probability range of where the index is likely to be within that time frame. So here's the thing, to Gary's point, or Jerry's point. This is the likely area that the price of this index is going to be theoretically between now and expiration on the 25th. That puts the majority of this trade, in fact, all of this trade, including some that maximum loss range, within the area of that potential possible move that the market might make. However, this right here is trend agnostic. This does not take into account trend of the market at all. So this just assumes straight baseline probability based on implied volatility of movement, 1 standard deviation up or down from where the market is right now. If we account for trend, which is what we were doing with our directional selection of the short put vertical versus the short call vertical, and we take a look at what those trend indicators are telling us, theoretically, this should continue to move higher. But at the moment, a couple of things worked against us. We're buried kind of in the lower left-hand side of this probable range. Number one, because the market's come down. Number two, implied volatility has gone up. So we're at the point where we're going to take perhaps some theoretical loss in this trade. Not the max loss in the trade, but we're going to take some theoretical loss following that 14.7. Now, I'm going to reiterate this. The reason that we do this, the reason that we're establishing that consistency, is because there is the risk of taking that maximum theoretical loss all the way through until we close this trade down. So if we were to hold it deeper to expiration, if the trade has started to make money for us, we're getting into a diminishing cycle of how much we're able to collect between now and expiration, because the rate of time decay slows down on an out-of-the-money option prior to expiration. In an at-the-money strike, we've talked about this before, in an at-the-money strike, the rate of time decay increases, okay? In an out-of-the-money strike, that rate of time decay as we get closer to expiration, in fact, inverts and decreases. I'll show you that here in just a second. So what we're structuring this trade to do is capture the majority of the time decay in the first week and then get out. And if we leave some on the table, that's okay, because we're carrying all of that potential risk of max theoretical loss all the way to the time that we close the trade. We don't want to do that because we're not getting the benefit of time decay, which is the one certainty in all of this. So we're going to close this one down, but now that we've seen it on the Analyze tab here, let me pop back over here to the Trade tab really quick and to the option chain. So here's the one that expires 7 days from now. This is SPX, okay? And we're going to pop into this, and let's take a look at, I'm going to bring this down. I'm going to look at just theta. So we're going to look at just the theta numbers. Okay, so here we are. Let's find our out of the money put options. Here we are. Here's our out of the money put option. Look at what our theta is here. This is 7 days out from expiration. Okay, I'm going to use the same strike price. Okay, the 67.20. I'm going to use the same strike price, and we're going to go out to 14 days, for instance. So I'm going to go to the 67.20 strike. Go to 67.20, and we can see what our theta number is. Okay, theta in this particular case, because that price has moved, $3.11. So now we're kind of at the cusp where that time decay is working for us. Now, if we go inside this 7-day time frame, let's go to 5 days to go until expiration, and we'll go to the 67.20. Here's our 67.20. 405, roughly the same theta. Theta has essentially slowed down. Now let's go to 2 days to go until expiration. We'll go to the 67.20 strike. 67.20 strike. Theta has now gone to $6.26. So it's given us a little bit of an acceleration. And part of that, again, is because of that implied volatility and because the market has moved. When we put this next trade on, we'll go through the same exercise and we'll see what that theta profile looks like. We're getting a little closer in this particular case to the at the money strike, because notice that our delta in this, the 67.20 has stayed just about the same in this particular case. All right, so let's do this. Let's go back to our monitor tab and let's manage this one. It's currently sitting at $3.15, $3.20. We're going to buy this one back. So we're going to create a closing order. And we're going to try to work that inside just a little bit. We'll work that down to the midpoint. Again, this is paper money. It's likely to fill just about at that midpoint. We're going to buy that one back and eliminate that obligation, but that obligation doesn't exist until we get to expiration. We're not going to hold it till expiration. We're going to eliminate this, and we're going to pay a little bit to buy that back. So we're sacrificing what we made in it plus a little bit. So we're taking a small theoretical loss. So now let's go back to the chart and let's see what we're going to do. So the price of the stock in this iteration, or the price of the index, still above the 200 period moving average. So we're still selling put spreads in this iteration. The other one we changed, but this iteration, we're still selling put spreads. We're going to take our time hack. So we know that we go back to our trade tab. We know that 14 days to go from now is our 4th of March expiration. So let's go back to our chart. Let's take that time hack. We'll move it forward to the, what did we say, 7th of March? 4th of March, right? 4th of March. Oops, not right there. Right click, activate, 4th of March, right there. Boom, put it in place. Just double check that. 14 days, 4th of March. Got it. Okay. So now what we're going to do, and you can see the impact that this rise in implied volatility has had, and the move to the downside a little bit, because it's moved our current strike crossover, where this timeline crosses over that 1 standard deviation probability curve. It's moved it down to, I'm going to put the crossover here, just about the 6,600 level. Not too particular, not too precise about this. I'm going to find a big round one. It's likely to have better open interest, tighter bid-ask spreads at that big round one, the 6,600. So I'm just going to put my line in there, in that 6,600. And you can kind of see how that rise in implied volatility over the last few weeks has widened out this probability curve. So we're going to sell the 6,600. So let's go back to the trade tab. And let's look at the 14 days to go until expiration, 6,600 strike. So we're going to go right here, 17-cent delta. Notice what its time decay component is, $2.65. So if we look at the 6,600, we're going to sell the 6,600 and we're going to buy the 6,580. That's a 20-point wide vertical spread. So that's going to get us roughly $2.30 of credit. But before we put that order on, I want to do this real quick. I want to take that same strike, the 6,600, right? The 6,600 strike. And I want to look at that as we go closer to expiration. So here's our 14 days to go. Let's go to 12 days to go until expiration at the 6,600 strike. 6,600 strike. Still our theta is at about 265. We go out to, let's go down here to 9 days to go at the 6,600. About $3.14. So it started to tip and it started to accelerate. We're catching the majority of that. Let's go to 8 days to go at the 6,600 strike, $3.08. Let's go to 7 days to go at the 6,600 strike. Now you see that rate of theta, which we would expect to accelerate, right? Because remember, when we normally look at time decay, as we get close to expiration, that normal rate of time decay looks something like this at an at-the-money strike. It goes zoop and falls off as we get towards expiration. These, because they're far out of the money, they're doing something that looks a little bit like this. They're going zoop and flattening out. Sorry for the sound effects. It just helps, right? So by selling this at 14 days and buying back at 7, what we're doing is we're capturing the steep portion of that time decay curve, and we're getting out before it just flattens out and really doesn't help us at all. That's the reason for the 14-7 structure in this trade. Could we make this 45 days and 10 days? Sure. Could you make it 45, or could you make it 30 days and 15 days? Yeah, you could do something like that too. Whatever you want to do. It's up to you to how you structure it, but that's kind of the scenario here in putting this together. So let's delete this. Yes, sound effect without using AI for sure. All right, so now let's do this. Let's come back in and let's stay at these same strikes. We're at the 6,600 strike. Let's go down to the 5 days to go until expiration at the 6,600, $2. It's kind of flat. 2 days to go until expiration. Let's go to the 6,600 strike. Where's our 6,600? $2. So we went from about $3 of time decay, $4 of time decay, down to $2 of time decay, and it's staying at about $2 of time decay. It's still working on that price. It's still working on it, but it's not accelerating. So we don't get an additional benefit by holding on to this necessarily. We're taking all the risk, but no additional benefit for holding on to this to get that accelerated time decay. And time decay is the big driver in this trade. to be sure. So we've queued this order up. And if we were to do this, let's right click, let's throw this on the Analyze tab, and let's take those two off, and you can see where that one is. Let's push this out to our March 4th expiration, and you can see that the majority of our range here, that expected move, falls within the max theoretical gain portion of that risk profile graph. So highly probable trade. Again, this is not trade. This is not, this is trend agnostic. We still have an uptrend. We're still selling put spreads. It's still in an uptrend. Therefore, that trend is still valid. And so it's still working in that case. So we're adding to that probability of the trade. That's the reason why we're doing this, to kind of get to that level. So let's fire this order off, pop that up, click on confirm and send, read through this order. We're going to put this back in our index options weekly group. We'll read through it. Max theoretical gain, $2.25. Max loss, $17.75. So theoretical max loss is a lot bigger, but again, the probability is we're not going to take that theoretical max loss. Now this, however, we're going to fire that order off and see if that fills, right? This becomes a circumstance. Let's go back to the chart. This becomes a circumstance when we're approaching that 200 period moving average, and it's starting, the trend's maybe starting to flatten out a little bit and volatility is rising. This is the point at which we could get whipsawed pretty quickly. And so we got to be careful with this longer lead time of using the 200 period moving average. So what we did then is we changed symbols so that we could keep these straight, and we went to the XSP. So I'm going to go back to the monitor tab. There's our SPX. Here's our XSP. And we did two trades on the XSP. We did one where we put a stop loss on, or a take profit order at, I think, what did we look at? Getting out of this at 20 cents? 16 cents, which was about an 80% max theoretical gain. We haven't hit that yet. In fact, we would take some loss in this trade since we're going to be closing this down today. In the other one that we did not put that loss on, or that take profit order on to differentiate it, we're going to take a very small loss, maybe 10-cent loss in that particular trade. But what we're doing here is, let's go back to this chart, is if we come back and we put on here another SIMP, simple moving average, let's put on here, we were using the 50 period simple moving average. So I'm going to make that kind of an orange color. I'm going to click on OK, apply an OK, and I'm just going to add this to the study. We'll save that grid so that we've got it. So here's our 50 period moving average. So we were above last week when we put this trade on, we were above the 50 period moving average. So we were selling put spreads. Now, at the moment, we are below the 50 period moving average. So we're going to pivot. We're going to sell a call spread in this particular case. So this may change things. So what we're going to do is we're going to come back over here. And I will tell you this, I'm just for the sake of this discussion, this is entirely the reason why I put these two different trades on here. I'm going to leave this one on as we get closer to expiration. We're going to leave that on to see what happens over the course of the next week, if it gets triggered on that max gain or on our 80% of max gain. I'm going to close this one down. So I'm going to right click and create a closing order, and we're going to buy that one back. And we're going to try to work that inside a little bit to inside that spread. We click on confirm and send so that we're taking about a 5-cent loss in this particular trade. Theoretically, we closed it down for 60 cents. That's about a 5-cent, maybe 10-cent loss in the trade. But now what we're going to do is we're going to go out to 14 days to go until expiration. We got to go to the chart again, and we have to move our time hack. So I'm going to right click. And let's see, are we still on? Nope, we got to move this. So right click, activate drawing. Let's move this out to the 4th of March. How is it the 4th of March already, or going to be the 4th of March? Now, because the index is below the 50 period moving average in this case, because remember we were trying to deal with that long lead of the 200 period moving average. Because it's below the 50 period moving average in this case, we're going to sell a call spread instead of what we have been doing, which is selling a put spread. So I'm going to go up here and we're going to do this hack right here, cross over that line, right there. We're going to say, all right, where's that crossover? 71 or 713, 714, somewhere in that range. Cross that over. So we've just flip-flopped. Now we're going to sell a call spread. So we're going to go back to the trade tab and we're going to open up our XSP. Remember, XSP is the smaller index, is the smaller version of this index. And so we're going to sell the 713. We should have a 713 because this has $1 wide strike increments. So we're going to come down here to the 713. There it is, 713. Happens to be about the 3-cent delta, 4-cent delta, way out of the money here in this particular case. And part of that is because this is a smaller index. So our delta falls off faster. But our theta is lower here in this particular case. So theta is not going to be the bigger driver necessarily here. In fact, vega is probably going to be the biggest influence here. So if implied volatility goes down, that's going to work in our favor. If implied volatility goes up, that's going to, work against us pretty quickly. So we are, in this particular case, we're going to go to the 713. We're going to sell that 713. And we're going to buy 2 strike widths. So 13, 14, 15. We're going to go to this one just to keep it consistent. 2 strikes, in this case, the 715. So what are we going to get in the trade? 8 cents. Not a lot. Let's do this. Let's do this even better. I think maybe we can create this a little bit better here. Let's sell that 713. We're just not bringing a lot. I'm going to come in 1 strike. Still the same delta. We're going to go to the 712. I'm fine with that because we're collecting a little bit more premium here. So I'm going to sell the 712. And I'm going to go out. Let's go to the 7. We don't have a 722, so we've got a 715. Let's go to the 720 in this particular case. 712 to 720. So it widens that width out a little bit, but it means that we're collecting a little bit more premium. It also means that our loss is going to be a little bit larger. So loss is a little bit larger, higher probability. However, this is a, 4-cent delta? And we're going to put this in our XSP, or in our index options weekly. If we do this real quick, analyze the trade, let's throw it over here, take these ones off so that all we're seeing is this one that we are currently analyzing. And let's kind of squeeze this down so we can see it. And let's set our probability range out to February 4th. You can see that we do have potential just in terms of that probable range. We want this to go down, the majority of our range, that probability range, but there is that little range here where we could take some theoretical loss if that plans out and goes to plan here. So that's how we're going to put this trade together. We're going to pop this back up. We might get caught in whipsaw here. We're going to see if we can work this a little bit. Let's see if we can get 21 cents. Out of this. Click on confirm and send, and we'll put this back in our weekly options, index options weekly group. Click on send, and we got it for 21 cents, which is great. All right, so we worked that order a little bit. So as we continue to do this, guys, what we're gonna find is we're gonna find that one of these or the other maybe starts to work a little bit better. And so we can adapt. But I wanted to establish, at least for a year, the consistency of doing that 14-7, come what may, and just kind of establishing that routine. In fact, that's already starting to work for us. Now we can start to riff on this and play with this a little bit. I'm interested to see what this one does. We'll hold on to this one. I will keep track of if that does fill on that exit order between now and next Wednesday. And then we'll keep an eye on this one between now and next Wednesday as well and see how that one plays itself out. If you want to learn a little bit more about index options or about some of the other ways to use index options, come on over here to the Trader Talks webcast page, INDEX, type in index options. And you're going to see a bunch of webcasts, including some that Connie has taught, because Connie is nice enough to fill in for me on a fairly regular basis in this webcast, including one that she taught on 0 DTE options on the last day of their expiration, and the day in the life of a 0 DTE option, but this is where you'll find the whole playlist of those index options. And by the way, if you are in the West Coast area, if you are on the West Coast area, come and join us on Saturday, February 28th for our Market Drive event in San Diego. We're going to be at, if we pop this open, show you where we're going to be. This is where you would go to register the Marriott Marquis San Diego Marina, right on the waterfront. Beautiful property, beautiful place. We're going to buy you lunch. We're going to buy you breakfast. We've got a networking reception afterwards. It's a great day of macro discussions as well as actionable insights. I'm going to be there. Barb's going to be there. Kevin Horner is going to be there. Kevin Hinks from the network, Alex Coffey, Joe Mazzola. It's going to be a great event. So come and join us. It is absolutely no cost to you. We'd love to have you register for it. Just click right there where it says save your seat. Come and join us. We'll see you then. Take care, everybody. Thanks to Connie Hill. Thanks to our great reviewers. Thanks to Bree for helping out with all of this. We'll see you soon. Take care, everybody. Bye-bye.